This is Module 1. Why GDP equals aggregate expenditure and aggregate income. The gross domestic product, GDP, is the total market value of the goods and services produced by a country's economy during a specific period of time. All goods and services produced by any agent in the country and sold for the first time. No resales are included, just the initial offering. It is used throughout the world as the main measure of output and economic activity. There are three final users of goods and services: households, businesses, government. Countries typically publish their GDP reports quarterly. Organizations such as the World Bank and International Monetary Fund collect the different countries' data and maintains a historical database. In the definition of GDP, market value refers to valuing production according to the market price. When countries report consecutive quarters of positive GDP growth, it is considered to be an expansion. Conversely, when it experiences 2 or more consecutive quarters of negative GDP growth, the economy is generally considered to be in a recession. GDP per capita, also called GDP per person, is used as a measure of a country's standard of living. A country with a higher level of GDP per capita is considered to be better off in economic terms than a country with a lower level. GDP is final goods produced in that country. Gross national product, GNP, which includes all final goods and services produced by resources owned by that country's residents, whether located in the country or elsewhere. Aggregate demand takes GDP and shows how it relates to price levels. Quantitatively, aggregate demand and GDP are the same. They can be calculated using the same formula, and they rise and fall together. Gross domestic product, or GDP, is used as a measure for the size of an economy based on the monetary value of all finished goods and services made within a country during a specific period. Aggregate demand refers to the total amount of money exchanged for those finished goods and services at a specific price level and period of time. Both measures are utilized by macroeconomics, although their usefulness, in practice, has been called into question by some critics. How the Bureau of Economic Analysis measures U.S. GDP and real GDP. There are 3 ways of measuring GDP, each of which should give the same answer. These methods are the output method, all value added by each producer; the income method, all income generated; and the expenditure method, all spending. Output method. Output, what is produced, minus the value of goods and services used up in producing these outputs, the inputs or intermediate consumption, plus all taxes on products like VAT, minus all subsidies on products like renewable energy subsidies. Income method. The income method measures GDP by adding together gross profit, the gross profit of companies and the self-employed, plus the wages of employees, compensation of employees, plus all taxes on products like VAT, minus all subsidies like renewable energy. Expenditure method. In the expenditure method, as the name implies, we measure how much is spent on goods and services. It is important that spending is only counted once. Consumer spending. Consumer spending by individuals, personal consumption expenditure, plus net expenditure by central and local government, plus all capital spending, such as buildings and machines, plus exports, since exports contribute to Ireland's GDP because it is spending by other countries on Irish-produced goods and services, minus imports because this total is spending on the output of other countries. In making these estimates, CSO uses a wide variety of sources. Almost all of the different inquiries conducted by CSO are used in one way or another. For example, data on employment from the Labor Force Survey, LFS, helps in calculating total wages and salaries. The Household Budget Survey is used in estimating personal spending, and so on. Over the last 100 years, the average U.S. growth rate in real GDP per person was about 2% per year. GDP numbers answers questions like, how fast is the U.S. economy growing? How does my state's economy stack up against others? Which industries are growing? Which are slowing? The White House and Congress use GDP numbers to plan spending and tax policy. The Federal Reserve uses them when setting monetary policy. State and local governments rely on GDP numbers too. Business people use these stats when making decisions about jobs, expansion, investments, and more. The uses and limitations of real GDP as a measure of economic well-being. GDP measuring has some limitations and is not always an accurate depiction of a country's well-being. GDP does not measure all production, as in some independent production such as home gardens, and cash paid for some services are not recorded. If someone has a neighborhood lawn service, it is not likely to appear in the reported number. GDP does not measure some aspects that are attributed to well-being, such as pollution. Quality of life, or well-being, is the standard of health, happiness, security, and material comfort of an individual, a group of people, or a nation. The real GDP per capita is the real gross domestic product of a nation, divided by the nation's population. This measure is an indication of the average income of a nation's people. Depreciation of capital, the decrease, is the value of a nation's capital stock over time. GDP accounts for investment in new capital, but does not subtract the lost value of depreciated capital. Because of this, GDP may overstate the amount of economic activity in nations with rapidly depreciating capital stocks. Economic growth is measured by changes in real GDP. If a nation's population grows, then growth in real GDP per person will be less than the growth of real GDP. Human Development Index, HDI, is a composite measure of nations' social and economic development developed by the United Nations that includes measures of health, wealth, and education. Genuine Progress Indicator, GPI, is a measure of a nation's quality of life that includes the income and output measured by gross domestic product. This measure subtracts out the cost of negative effects related to economic growth, such as crime, environmental degradation, resource depletion, and the cost of climate change. GPI nets the positives and negatives of economic activity to provide a more accurate measure of a nation's quality of life than GDP alone. Happy Planet Index, HPI, is a measure of a nation's quality of life that includes survey results on happiness, life expectancy at birth, the degree of inequality across society, and the ecological footprint. GDP is a useful indicator of a nation's economic performance, and it is the most commonly used measure of well-being. During the later half of the 20th century, Africa had the lowest level of real GDP per person. Why unemployment is a problem, and how we measure the unemployment rate and other labor market indicators. The employment rate and labor participation rate are two important indicators of a nation's economy. The workers in the labor force who do not currently have a job but are actively looking for work. People who have not looked for work in the past 4 weeks are not included in this measure. This means that there are actually more people unemployed than is reported to you, as people who are not working after 4 weeks cease to be counted but are still unemployed. There are several reasons the unemployment rate rises or falls. Although a clear reason is a change in the number of job seekers, the unemployment rate may also be affected by a change in the size of the labor force. When workers become discouraged and stop looking for employment, they leave the labor force. Since the COVID bailout of 2021 through 2023, many people who would have otherwise joined the workforce are being paid to stay home. This has caused a labor shortage for many industries. In this case, the administration touts the jobs report that shows how many new jobs are available. It avoids publicizing the labor participation rate, which indicate the percentage of working-age adults with jobs. Underemployment includes 3 groups of people: unemployed workers who are actively looking for work, involuntarily part-time workers who want full-time work but have had to settle for part-time hours, marginally attached workers who want and are available to work but have given up actively looking. Together, these 3 groups provide a more comprehensive measure of slack in the labor market. The working-age population can be divided into 2 groups: people in the labor force and people who are not in the labor force. Therefore, the unemployment rate is measured as the percentage of people in the labor force who are unemployed. Labor participation rate. The labor participation rate shows the number of people currently employed as a share of the total working-age population. which is the number of civilian, non-institutionalized persons aged 16 and over. This measure does not typically change dramatically from month to month, but even minor changes help identify which segments of the population are experiencing the most job loss or gain. The labor force participation rate shows the number of people in the labor force, the numbers of people with a job, as well as the number actively looking for work. Why unemployment occurs and why it is present even at full employment. Full employment is an economic situation in which all available labor resources are being used in the most efficient way possible. Full employment embodies the highest amount of skilled and unskilled labor that can be employed within an economy at any given time. It is a near impossibility that true full unemployment can exist where unemployment is at zero. Full employment is when all available labor resources are being used in the most efficient way possible. Full employment embodies the highest amount of skilled and unskilled labor that can be employed within an economy at any given time. Economists define various types of full employment based on their theories as targets for economic policy. Many modern economists agree that some unemployment is necessary to avoid inflation and to allow workers to move between jobs, pursue education, or improve their skills. Unemployment of 5% or lower is often considered full employment in a real-world context. Types of unemployment. Unemployment can result from cyclical, structural, frictional, or institutional causes. Policymakers can focus on reducing the underlying causes of each of these types of unemployment, but in doing so, they may face trade-offs against other policy goals. Structural. The desire to encourage technological progress can cause structural unemployment. For example, when workers find themselves obsolete due to the automation of factories or the use of artificial intelligence. Institutional. Institutional unemployment arises from institutional policies that affect the economy. These can include governmental programs promoting social equity and offering generous safety net benefits, and labor market phenomena such as unionizing and discriminatory hiring. Frictional. Some unemployment may be unavoidable by policymakers entirely, such as frictional unemployment, which is caused by workers voluntarily changing jobs or first entering the workforce. Searching for a new job, recruiting new employees, and matching the right worker to the right job are all part of it. Cyclical. Cyclical unemployment is the fluctuating type of unemployment that rises and falls within the normal course of the business cycle. This unemployment rises when an economy is in a recession and falls when an economy is growing. In the United States, the unemployment rate was 3.4% in January 2023, one of the lowest historical rates since 1948. The lowest unemployment rate in the U.S. since 1948 was 2.7% in 1952. The issue is that the starting point in which the administration decided to measure was the height of the COVID shutdown. Millions were laid off or had to quit during this period. When the lockdown was lifted, over 6 million people went back to work. The administration called this new job creation, when it was merely people returning to their jobs. The 3.4% unemployment rate is considered full employment. The result was rising inflation, made worse by deficit spending. That is to say, flooding the market with more dollars. More money seeking fewer goods causes inflation. When supply chains failed, it made the situation worse. This resulted in 40-year high inflation from 2020 through 2022. Full employment is when all available labor resources are being used in the most efficient way possible without triggering inflation. It is a theoretical state in which anyone who wants to find full-time work can do so, and unemployment is at 0%. Why inflation is a problem and how we measure the inflation rate. As touched on in previous sections, inflation is where too much money is chasing too few goods. It is measured by 2 or more consecutive quarters of negative GDP. Inflation is a rise in prices, which can be translated as the decline of purchasing power over time. The rate at which purchasing power drops can be reflected in the average price increase of a basket of selected goods and services over some period of time. The rise in prices, which is often expressed as a percentage, means that a unit of currency effectively buys less than it did in prior periods. Inflation is the rate at which prices for goods and services rise. Inflation is sometimes classified into three types: demand-pull inflation, cost-push inflation, and built-in inflation. The most commonly used inflation indexes are the Consumer Price Index and the Wholesale Price Index. Inflation can be viewed positively or negatively depending on the individual viewpoint and the rate of change. Those with tangible assets like property or stocked commodities may like to see some inflation, as that raises the value of their assets. When the Bureau of Labor and Statistics measures inflation, they leave out two key data points. They do not count food or fuel in the calculation. This makes the inflation rate appear much lower than it actually is. If an inflation rate of 6.2% is reported, the real rate as felt by consumers is much higher. As all citizens consume food and fuel in some way, it impacts everyone. It has been said that inflation is the cruelest tax of all because it hits everyone. When prices rise faster than raises in income, 1 unit of money buys fewer goods and services. This loss of purchasing power impacts the cost of living for the common public, which ultimately leads to a deceleration in economic growth. The consensus view among economists is that sustained inflation occurs when a nation's money supply growth outpaces economic growth. The Consumer Price Index, CPI, measures the change in the cost of goods from the same time the year before. The Producer's Price Index is the change in cost for producer to produce the same goods a year before. If the cost of the producer goes up, so will the cost to the consumer. For example, if a change in policy causes the price of oil per barrel to increase, then transportation costs increase. All goods that rely on transportation will increase, as does the cost of daily travels. This means that your money is not going to buy the same amount of goods it did a year earlier, making the dollar worth less. This is inflation. Causes of inflation. An increase in the supply of money is the root of inflation, though this can play out through different mechanisms in the economy. A country's money supply can be increased by the monetary authorities by printing and giving away more money to citizens, legally devaluing the legal tender currency, loaning new money into existence as reserve accounts credits through the banking system by purchasing government bonds from banks on the secondary market, the most common method. In all of these cases, the money ends up losing its purchasing power. The mechanisms of how this drives inflation can be classified into three types: demand-pull inflation, cost-push inflation, and built-in inflation. Advantages and disadvantages of inflation. Inflation can be construed as either a good or bad thing depending on which side one takes and how rapidly the change occurs. Pros. Individuals with tangible assets, like property or stocked commodities, priced in their home currency may like to see some inflation that raises the price of their assets, which they can sell at a higher rate. Inflation often leads to speculation by businesses in risky projects and by individuals who invest in company stocks because they expect better returns than inflation. Cons. Buyers of such assets may not be happy with inflation, as they will be required to shell out more money. People who hold assets valued in their home currency, such as cash or bonds, may not like inflation, as it erodes the real value of their holdings. As such, investors looking to protect their portfolios from inflation should consider inflation-hedged asset classes, such as gold, commodities, and real estate investment trusts, REITs. Inflation-indexed bonds are another popular option for investors to profit from inflation. Controlling inflation. A country's financial regulator shoulders the important responsibility of keeping inflation in check. It is done by implementing measures through monetary policy, which refers to the actions of a central bank or other committees that determine the size and rate of growth of the money supply.